RBI's Financial Stability Report (FSR) reveals the gross non-performing assets (GNPA) ratio has been gradually trending downwards from 9.3% in September 2019 to a 7-year low at 5.0% in September 2022, while net non-performing assets have dropped to a 10-year low of 1.3% of total assets. The stress tests in RBI's Financial Stability Report showed that banks are capable of absorbing shocks even under adverse situations. Let's do an in-depth analysis of the report to determine its trend, the policy actions that have been helpful, and what can be done to make things even better. While the economy is facing global headwinds, macroeconomic fundamentals and healthy balance sheets provide strength to the financial system. Capital positions of banks were strong in September 2022. Macro stress tests show that banks are well capitalized and capable of absorbing macroeconomic shocks even under adverse stress situations. The RBI stress tests assess banks' resilience to exceptional but plausible stress events. Macro stress tests cover interest rate risk, credit risk, and liquidity risk, and estimate the resilience of commercial banks in response to these shocks. RBI assesses capital ratios over a 1-year horizon under a baseline scenario and to adverse scenarios i.e. medium and severe. It assists in the decision-making process, especially in terms of potential actions like risk mitigation techniques, contingency plans, and capital and liquidity management, and helps top bank managements foresee the bank's condition in stress times. The ratio of gross NPAs to gross advances fell from 5.9% in March 2022 to 5.7% in June 2022 to 5.0% in September 2022, as against 9.3% in September 2019, facilitating broad-based expansion in bank credit. Lower fresh accretions to NPAs have been a major contributor to this. Stress tests show that GNPAs may fall further to 4.9% by September 2023. The game changer was the Insolvency and Bankruptcy Code introduced in 2016, which altered borrowers' behavior drastically. Even before IBC became effective, borrowers began lining up before lenders to repay dues. Moreover, the central bank has been maintaining the reserve ratios at 4.5% CRR and 18% SLR for quite a long time, despite making credit costly in terms of continuous hikes in policy rates. Of course, the post-pandemic economic revival is in no way less responsible for credit disbursal going up. The current practice of RBI assessing the situation and NPA trends does not go to the root of the problem. The RBI could start by separating willful defaults from the ones due to an investor-friendly environment, the latter being almost half of the NPAs. While the first category needs to be dealt with stringent laws, the latter demands reforms in archaic business laws such as labor reforms, especially in the absence of an exit policy.